Another thing that's already happening, you say, is the policy rate is already neutral. So we're talking here about R-star. Elaborate on this. What R-star means, where it is now, and the FOMC is kind of dispersed on what R-star is, right?
Yeah. John Williams and his co-author Thomas Lubick have convincing evidence that this so-called R-star is a lot lower than it used to be. I think the simplest way to think about it is as the trend measure of the short-term real interest rate. It's the trend component. The Fed does influence that rate, but it doesn't influence the trend. So the question is, where's the trend rate? I say it's probably still negative today, and so if you take that as a starting point, a real short-term real interest rate being negative, you add 2% inflation to that, you're going to get something less than 2% as the neutral federal funds rate, and we're already right there. So that's the idea, is that we're pretty close to neutral today. If we start going up from here, we're going to get into restrictive territory, which is going to put downward pressure on inflation. Do we really want to do that when inflation expectations are already hovering below our target for the next 5 years?
Why do some of your colleagues have higher neutral rates, 2.5, 2 3/4? Some seem to be up around 3.
There are a lot of estimates around it. It has wide confidence bands around it, so there is certainly room for argument on this, but I think it's probably pretty low. It's also a global yield, so global rates are really low, and our rival central banks in Japan and Europe still have negative policy rates. So the idea that the U.S. is going to break out of a global equilibrium that's really low, I think, is not that likely.